Let's talk some retail to close out today's show and welcome in Don Nesbitt, CIO, ZCM Equity Group. Don, thanks so much for joining us and wrapping up the show with us.
Thanks for having me.
So we had an influx of retailers reporting earnings recently. We'll have some more next week, which should shed some more light on the consumer. But overall, what would you say the key takeaway about the state of the consumer is right now?
Yeah, well, the consumer is very apprehensive. We saw in a recent October consumer confidence reading that almost 2/3 of them are expecting a recession in the next 12 months. Of course, this recession has been eluding us. Economists have been calling it for over a year now, I think. However, I think that the tighter fiscal policies by the Fed, the stimulus that was from the government, those effects are starting to come home now, and they're starting to hit the consumer. There are higher rates on their credit cards, tighter lending standards. A lot of the students' debt has to begin paying again, and so these things are starting to wear on the consumers. In addition, all the savings that they'd accrued during the pandemic has basically been spent through by the lower 2/3 to 3/4% of the consumer. So they're out there and they're very apprehensive. Now, the good news is the employment is still strong. And as long as consumers have jobs, they will spend. So they have continued to be resilient. Third quarter spending with the Taylor Swift and Beyonce tours, juiced the economy. However, again, they've basically blown through a lot of money. They're apprehensive and they're worried about what's to come.
But I guess here's the thing, because there's a difference between how people feel and how they act, right? So they're apprehensive, but are we actually seeing that play out in terms of their spending habits yet? Because it seems like they're still spending $500 or $1,000 on Taylor Swift tickets, or consumers are spending to upgrade their flights to business class or more legroom. The commentary still seems cautious, but that the consumer is still pretty strong.
Yeah, perception's reality. And right now, so far, the consumer's been pretty strong. The reality's been strong. But as I said, they are starting to get a little worried. Confidence is starting to diminish. As I also said, what's been supporting the consumer and their spending is jobs. As long as they have jobs, they'll continue to spend, albeit not maybe at the rate they've been spending over the past summer or year. The spending may slow down, but it still should remain healthy. But the Fed is working to basically, end that party, right? We're starting to see some of the cracks fall out, and temporary hiring is down. For those who lose their jobs or leave their jobs, it's taking a longer time to find a job. So it's starting to show, and I think that's why you're seeing the consumer themselves become a little more apprehensive.
But if it's determined, if the job market's really what determines how strong the consumer is, the holiday season is upon us, right? Santa Claus is here ringing the opening bell, Salvation Army is here ringing the closing bell, so the holiday season is here officially. I guess, what does this all mean for the holiday spending period? If people still have jobs, should we expect a strong consumer spending period this holiday season?
Well, as long as they have jobs and they have the incomes, of course. But and you saw in the earnings release by Walmart, which is one of the larger retailers, obviously, that there was nothing to overly worry about there. But however, that's a great case of what's going on within the consumer and the spending patterns. Where actually we saw during the pandemic a lot of money was spent on physical goods. Of course, as we came out of the pandemic, that became a problem because stores like Target and even Walmart, to some extent, but not quite as seriously, overinvested in their inventory. People had bought all the things they needed. Now they were turning to services. So what we've seen here is Walmart is still looking for a decent, I think, holiday season, although no retailer is going to come out there and say at this moment that they're expecting gangbusters. They're going to hedge their bets. But they're preparing. And the thing we see from Walmart is we're seeing some higher income consumers in maybe the middle and even lower upper middle class move down and start visiting their stores again as they become more apprehensive about this economy.
Well, Target and Walmart, of course, the two big ones. Walmart up about 10%, 9% year to date. Target down 12% year to date. But then you compare it to an Abercrombie and Fitch, say, which is up 218% year to date, or even an Urban Outfitters, which is down 12% today, but up 33%. What's going to separate the winners and losers from a stock perspective, do you think, when it comes to retailers?
Well, let me focus on what happened with Walmart and Target there. And as you said, Walmart up until November 14th, when Target reported, was up about 20%, and that looked pretty good against the S&P, which is up 18.5%. Keep in mind too that we've been hearing about how the S&P has been powered by the Magnificent Seven, the tech stocks, things like your former speaker was talking about. So Walmart looked pretty darn good. We were actually had an overweight in Walmart and we've been there because we've been expecting a slowdown like many others for the last year. And as I said, the lagged effects of of monetary policy are starting to come through. The fiscal stimulus is starting to run out, and we're still happy with our position. Now, Target, contrary to Walmart, was down, as you mentioned, some 23%. There were very poor expectations or low expectations built into Target. Remember when I talked about during the pandemic, these retailers had built up their inventories, and that was what Target's sin was. They overbuilt their inventories. They had to go on fire sale. Investors punished them for that. Actually, Walmart did a pretty good job its way through the supply chain issues, through the higher prices, and so they've been able to keep and attract their customer base. However, last June or so, we noticed that Target had become very, very cheap on a relative basis. So you can talk about a good company and what makes a great company, but a great company doesn't necessarily make a great investment, right? So Walmart, we felt, was doing okay, was fully valued, but Target, we felt, had overcome a lot of those issues and was selling at roughly half the multiple of Walmart. So we took some of our holdings from Walmart and put that into Target. But that kind of gives you an idea of how I think you want to look at this industry. Is you have the stalwarts like the Walmarts, the Costcos, who are going to weather out a recession a little bit better, versus some of the names that, especially higher end or item specific that you had mentioned earlier.
Okay, we have to leave it there, but Don, all good insights there. Thank you so much, Don Nesbitt of ZCM.